In 2025, AI infrastructure investment is projected to eclipse $500 billion. It's a figure so staggering it could reshape economies, disrupt industries, and change the way we work. But here's the catch: Mark Zuckerberg is warning us. This AI boom could collapse just like the dot-com bubble. We're at a crossroads in the world of technology. On one side, we have the promise of AI, a technology that some believe will lead to unprecedented breakthroughs. On the other side, we have a darker possibility. The very technology that's being hailed as the future could be leading us straight into the same disastrous fate as the dot-com bubble of 2000. You might be wondering, what exactly does Mark Zuckerberg know about this AI bubble? It's simple: he's been at the forefront of massive tech shifts for decades. And now, as the leader of Meta, he's sounding the alarm on what could be another catastrophic market correction. Consider this: in the late 1990s, internet companies were valued at astronomical rates, many based on speculation, not actual profitability. Investors flocked in, driven by the belief that the internet was the future, until the bubble burst, erasing trillions in value. We all know how that story ended, but today we're seeing the same signs in the AI space. Companies are skyrocketing in value, but many have yet to prove their business models are sustainable. The hype is real, but is it built on solid ground? This should be a wake-up call, because just like the dot-com era, you could either find yourself riding a massive wave of success or drowning in a market collapse. And the choice of where you stand is critical. If you don't act now, there's a real chance you'll miss out on opportunities that could offer substantial returns. But if you dive in without caution, you might be left holding the bag when this bubble bursts. I'm not here to tell you what to do with your money, but I do want you to consider the risk. AI could offer great potential, but it's essential to approach this space with a long-term strategy, not just the quick thrill of speculation. You need to be discerning about where you put your money. Make sure the fundamentals are there, and keep an eye out for companies that are genuinely innovating, not just riding the wave of hype. Now that we've established the dangers of an unchecked AI boom, let's break down how the valuations today might not be as sound as they appear. If we're not careful, the same thing could happen that happened with the dot-com companies: overinflated values that lead to catastrophic falls. But is there a way to spot the red flags before it's too late? Let's take a closer look at the valuations driving this market. In the late 1990s, the world saw one of the most dramatic investment booms in history. The internet companies, which were little more than early-stage ideas, were valued in the billions. At the height of the dot-com bubble, investors were throwing money at businesses with little more than a flashy website and a promise to revolutionize the world. The result: a catastrophic collapse that wiped out over $5 trillion in market value and left many investors holding nothing but worthless shares. What's shocking is that today, we're seeing a very similar situation unfold in the tech world. But this time, it's not the internet that's being hyped up, it's artificial intelligence. Tech giants like OpenAI, which have yet to prove they can turn a profit, are now valued at billions. And the question must be asked: are we heading toward another bubble? Could AI be the next great speculative disaster, just like the dot-com bubble was? Let's talk about Facebook's Mark Zuckerberg. As someone who's been deeply involved in the tech industry for years, Zuckerberg has seen these cycles before. When asked about AI and the future of technology, he's expressed caution about the massive valuations being placed on emerging technologies without real, sustainable business models. This is a warning that we can't ignore. In the late 90s, there was an overwhelming sense of optimism about the internet, despite the fact that many of the companies we now associate with the dot-com bubble weren't profitable. Take Webvan, for example, a company that promised to revolutionize grocery delivery. Investors were throwing money at Webvan, betting it would become the next Amazon. But when the bubble burst, Webvan was left with nothing but debt, and investors lost billions. The same kind of blind optimism is happening today with AI. Look at the billions being invested into companies like OpenAI. They're promising big things in industries like healthcare, finance, and even creativity. But the core question remains, is this just a repeat of the overvalued promises of the past, or does AI truly have the potential to change the world? Let's dig deeper into the numbers. A prime example here is OpenAI, one of the biggest players in the AI space. It's currently valued at around $30 billion, yet it hasn't reported consistent profits. Despite this, the hype surrounding its future potential is enough to lure billions of dollars in investments. That's a $30 billion valuation for a company that's not yet profitable. Now let's break that down further. If we compare this to an established tech giant like Microsoft, which has a market value of around $2.5 trillion, we can see how unusual this is. Microsoft consistently reports profit margins of over 30%. For every $1 billion invested in Microsoft, you can expect to see around $300 million in profit. So for every dollar you're investing in OpenAI, the return, if any, is speculative at best. But here's the real issue. The math doesn't add up. With OpenAI's current trajectory, it could take years, if not longer, for the company to become profitable enough to justify its $30 billion valuation. And that's a massive gamble for anyone betting on its future. Now, let's address the emotional side of all of this, the fear and greed that drive investment decisions. You don't need to look far to see the allure of AI investments. The potential is enormous. Imagine being part of a company that's poised to change the way the world works, to be at the forefront of a technological revolution. Early investors in companies like Amazon and Google saw their small bets turn into unimaginable fortunes. Who wouldn't want to get in on that? But here's the counterpoint. The risk involved here is enormous. If the AI bubble bursts like the dot-com bubble, it won't just be tech investors feeling the pain. A crash could send shockwaves through global markets, affecting everything from your retirement savings to the overall economy. For every story of an Amazon-like success, there are dozens of examples of companies that disappeared without a trace, leaving investors holding the bag. The question is, are you ready to take that risk? If you're investing in AI because you're chasing the dream of huge returns, be mindful of the fact that high returns come with high risk. And if the market turns, it could leave you with nothing but regret. It's not about if the bubble bursts, but when it will burst, and you don't want to be the one caught holding overpriced speculative investments when that happens. So what should you do? First and foremost, take a step back and assess the underlying value of the companies you're considering. Are they genuinely building sustainable business models, or are they riding on hype and empty promises? Look, AI is undoubtedly a transformative technology, but don't get blinded by the potential for massive returns. As an investor, your goal should always be to protect your downside. That means focusing on companies that are already profitable, that have solid cash flow, and that can weather economic storms. Don't get caught up in the hype of unproven ventures that are worth billions but have yet to prove they can deliver. Another key point is diversification. Yes, AI can be a part of your portfolio, but it should never make up the bulk of it. Balance your tech investments with more stable, income-generating assets. A diversified portfolio will help you manage risk and capture opportunities without putting all your eggs in one basket. Now that we've looked at the dangers of getting swept up in speculative AI investments, let's take a closer look at what happens when speculation overtakes genuine investment. How do we distinguish between a market fueled by real innovation and one driven by hype? And more importantly, what happens when the market corrects itself? The dot-com bubble of the late 90s left a permanent mark on the way we think about speculative investments. In the world of AI today, we see similar patterns emerging. Zuckerberg's cautionary words echo a sentiment that is increasingly difficult to ignore. AI may hold incredible promise, but the risk is high, and if you're not careful, you could end up on the losing side of the next major market correction. The key takeaway is simple: don't invest on speculation alone. Whether you're diving into the world of AI or any other emerging technology, make sure you're evaluating the fundamentals and not just chasing a dream. Your financial future could depend on it. Imagine this: in just the last year, Nvidia's market cap soared to over $1 trillion. Trillion dollars. This is the same company that only a decade ago was largely known for gaming graphics cards, but today it's being touted as the leader in AI technology. And it's not just Nvidia. Companies like Meta, Amazon, and Google are betting billions on AI, positioning themselves as the future of everything from self-driving cars to healthcare innovations. At first glance, these valuations seem impressive, even visionary. But the question remains: are they based on real value or just the promise of a future that may never come? Today, we're diving deep into how the AI market has inflated beyond its current ability to deliver, and why investors need to be cautious when looking at these multi-billion-dollar companies. The risk is far higher than many realize. Let's start with the numbers. Nvidia's stock price has skyrocketed, increasing by more than 200% in just a matter of months. But this isn't simply due to booming sales from gaming. It's about AI, more specifically, the massive demand for AI chips used to power machine learning algorithms. However, does this valuation truly reflect sustainable earnings, or just the market's speculative belief in the potential of AI? When we look at other tech giants like Meta and Amazon, we see a similar story. Meta has doubled down on AI with their massive investment into their metaverse project. Yet, as of now, the metaverse is still years away from being a viable source of revenue. Amazon, too, is pouring billions into AI, but their returns remain unclear. These companies, while giants, are betting big without a clear timeline for profitability. It's easy to get swept up in the excitement of AI, but we need to look at the fundamentals. The reality is that while these companies are investing heavily in AI, the revenue streams are speculative at best. The promise is big, but the payout, that's still a long way off. Let's take a closer look at the valuation math. Nvidia's valuation is now hovering around $1 trillion. Yet, for a company of that size, its annual revenue isn't even close to the scale of its market cap. To put it simply, when you pay $1 trillion for a company, you expect it to be generating far more than $25 billion in revenue a year. The math just doesn't add up, and it's not just Nvidia. Meta's stock has surged, yet its AI efforts, such as the metaverse, have yet to prove they can generate consistent revenue. Amazon, despite its massive cloud services business, is still working on its AI capabilities and has yet to deliver on the promises made to investors. If these valuations are based purely on potential, not current or near-term profitability, the bubble is only getting bigger. The same concerns can be raised for a lot of these companies. They're betting on AI to lead them into the future, but how much is AI actually worth today? This brings us to the warnings we should all be taking seriously. Mark Zuckerberg, who has seen his fair share of investment cycles, has voiced his concerns over the immense amounts of capital pouring into AI without a clear path to generating revenue. Zuckerberg himself has warned that the speculative nature of these investments could lead to a painful market correction. If we look at the financial models of these companies, it's clear that they're prioritizing long-term potential over short-term returns. But remember, tech companies like these have historically overestimated the time it will take to monetize new technologies. This doesn't mean AI won't be huge, it will, but it could take far longer than most are anticipating. And that could lead to devastating losses for those who invested too early or at inflated prices. For investors, the warning is clear. There's a real risk of overpaying for stock based on what could be a false sense of value in the short term. This is where psychology plays a massive role. We've all heard the stories: early investors in Apple, Amazon, and Tesla making billions. It creates this sense of urgency to not miss out. That fear of missing out, FOMO, is powerful. When you see everyone else piling into a stock, it's tempting to believe you have to act now before it's too late. But here's the thing, FOMO often leads to overpaying. And in many cases, that's exactly what's happening right now in AI investments. When investors see these massive valuations, they assume the value will continue to climb at an exponential rate, and they rush to get in. The problem is when the market corrects itself, and it always does, the value isn't going to be there. Those who overpaid will be left holding the bag. The problem is that AI as a technology still has a long way to go before it can generate the returns investors are expecting. The potential is undeniably massive, but the reality is still catching up, and that's where risk comes in. Now let's bring back the emotion behind all of this. The reason people are investing in AI isn't just because of the technology. It's because of the greed for a massive return on investment, and that's understandable. Who wouldn't want to invest in something that could reshape the world? But here's the reality. For every massive success in AI, there are countless other projects that failed. The fear of missing out is real, but so is the fear of losing everything. What happens if you get caught in this bubble? You might end up losing significant portions of your investment. You might have to wait years or longer for these technologies to mature and start generating real revenue. If the AI bubble bursts, the consequences will ripple through the economy, affecting not just tech stocks but everything else as well. What should you do? First, recognize that AI is not a sure thing. The hype is real, but the returns are speculative. Be cautious when entering into investments based on future potential without clear indicators of profit. It's better to invest with patience rather than rush into speculative markets out of fear. A balanced approach is key. Diversification should be a cornerstone of your strategy. Don't pour everything into AI or other speculative tech stocks. Look for companies that are already profitable, that have proven business models, and that aren't overly reliant on untested technologies. Having laid out the risks of overvaluation and the speculative nature of the AI boom, it's important to also understand the psychological pressures that investors face. How do we balance the potential of high-reward investments with the underlying risks? And what's the next step in navigating this uncertain landscape? As we can see, the rapid rise of AI valuations is a double-edged sword. On one hand, AI is undoubtedly a transformative technology with the potential to change the world. On the other hand, the massive investments pouring into these companies are based on speculative bets rather than tangible returns. Understanding this distinction is critical for any investor looking to navigate this market wisely. The key takeaway is this: don't get caught up in the hype. While AI offers incredible promise, its current valuation may be too inflated for the true potential it holds today. Be careful where you put your money and always keep a long-term perspective on your investments. In today's world of high-stakes investments, it's easy to get swept up in the frenzy of the latest tech boom, AI being the most obvious example. But here's the truth: patience has always been the true key to long-term wealth. Yes, quick gains are enticing, but they come with massive risks that can backfire when the bubble bursts. Mark Zuckerberg, for instance, has often spoken about the dangers of buying into the AI hype without a solid long-term plan. He knows firsthand how valuable it is to wait, to let value build slowly, and to avoid getting caught up in the rush for fast profits. In the dot-com era, companies that focused on quick growth at any cost saw their stock prices soar, only to crash once the reality of unsustainable business models set in. Compare that to companies like Facebook, which built slowly but steadily, focusing on long-term value creation. Zuckerberg himself has often said, "A rush to grow too fast can lead to a painful collapse." Today, many investors are making that same mistake with AI. Let's break this down. When you look at the dot-com bubble, you see a similar pattern. Companies were rushing to capitalize on the internet revolution. Valuations were high, expectations were inflated, but the true value wasn't there. In the end, many of those companies couldn't live up to the hype. The dot-com bust wiped out massive amounts of wealth for those who invested based on short-term speculation. Fast forward to today, and the same thing is happening in the AI space. Tech giants like Meta, Amazon, and others are pouring billions into AI technologies that have yet to generate significant revenue. Investors are buying into the promise of AI's future potential, but the reality is much more uncertain. What's important to understand is that those who focus on short-term gains, riding the AI wave of hype, are far more likely to lose out when the market corrects itself. Conversely, companies with solid fundamentals like Facebook in its early years focused on building sustainable business models, even when short-term results weren't as flashy. Zuckerberg's cautionary approach has paid off in the long run, while those chasing quick wins in the dot-com days found themselves left with losses. Here's the critical warning: the market is prone to corrections. The AI hype, as powerful as it may seem right now, is not immune to the forces of reality. When the market inevitably corrects, those who overpaid for AI stocks based on speculative promises will suffer the most. Zuckerberg's warning rings true: don't rush into investments with unsustainable expectations. This could be the moment when we see another tech crash, similar to what happened after the dot-com boom. The lesson from history is simple: patience always wins in the end. The early investors who bet on solid fundamentals, who didn't panic when the market corrected, are the ones who made the most money over the long term. Let's talk about data. Companies that focused on sustainable profitability, like Facebook, didn't rush to the market with speculative promises. Instead, they focused on the long-term game, creating a solid user base, refining their product, and eventually becoming the dominant force in social media. Those who understood this slow burn were rewarded, but let's be honest. There's a temptation that drives so many investors today: the fear of missing out. It's hard to sit on the sidelines when everyone's talking about AI being the next big thing. You've heard the stories about early investors who made billions from taking a risk. The idea of missing out on that kind of opportunity is enough to make even the most cautious investor question their strategy. But here's where the emotional charge kicks in. When the bubble bursts, as it always does, it's the patient investor who stands to benefit the most. When the market crashes and panic sets in, the ones who have held their positions with patience will be ready to seize the opportunity. Consider this: when everyone else is running for the exit, the patient investor can pick up solid assets at a discount. This is how wealth is built, not by chasing every shiny new object, but by recognizing when to wait and when to act. Let's take a moment to reflect. It's not easy to resist the urge to jump into the next hot investment. But remember, the key to lasting wealth isn't found in quick wins. It's in the steady, long-term strategy. Zuckerberg's approach, despite all the hype around AI, is a reminder that patience and capital preservation are the pillars of a sound investment strategy. The critical question here is: are you willing to wait? Will you stand firm when others are panicking and rushing to invest? Or will you let fear drive your decisions, leading you to invest in inflated valuations that may never pay off? The future of AI is uncertain. The market is volatile. But when others panic, the patient investor can seize the opportunity. Be that investor. Having discussed the importance of patience in building wealth, let's now shift our focus to how you can apply this mindset to your own investment strategy. We'll explore practical steps you can take to manage risk, build wealth over time, and avoid the common pitfalls of the speculative investment landscape. In the world of high-risk, high-reward investing, patience is the most underrated asset you have. It's tempting to chase after the quick returns promised by AI and other emerging technologies. But history has shown us time and again that the true wealth is created by those who play the long game, resist the urge to overpay during hype, and keep their cool when the market corrects itself. So take a deep breath, stay focused on your long-term goals, and don't let fear of missing out push you into decisions you'll regret later. The best opportunities often come to those who wait. Let me leave you with a sobering thought. In 2000, the world was convinced the internet would revolutionize everything. Investors, from the biggest financial institutions to individuals, poured billions into tech companies, certain that these businesses would reshape the economy. But they didn't. The dot-com bubble burst and many paid a high price. Today, the excitement is palpable again, but this time it's AI. As tech giants and venture capitalists alike bet on unproven technologies, we're faced with an eerily familiar situation. History is repeating itself, but this time the stakes are even higher. Let's reflect on the lessons of the past. In the late 1990s, the internet was touted as the greatest investment opportunity of a generation. The promise was too big to ignore. Companies like Petscom and Webvan raised millions, despite having business models that made little sense. They were selling hope, not profits. And when the bubble finally popped, those who bought in too quickly lost everything. Fast forward to today, we're seeing similar optimism surrounding AI. Huge sums are being poured into AI companies. OpenAI, for example, is valued at over $500 billion, yet it has yet to demonstrate sustainable profitability. Big players like Meta and Amazon are rushing to capitalize on AI, but without a clear revenue-generating model, many are simply speculating on future potential. If you're watching this, I want you to ask yourself, are you investing in the future or are you getting caught in the excitement?